Hello, everybody. Welcome back to the session. So, we are discussing fundamental analysis, and in that series, we are starting a new topic today that is ratio analysis. Very interesting topic, and it will make your equity research bit smart, bit effective, bit time. It will decrease the time of equity research. So, guys, let's start with the ratio analysis. Ratio analysis is the tool basically to evaluate the relationships. It's very important, huh? Relationships between the financial data. Now, this relationship term, I would like to say that the ratio is used to find relationships amongst the headings of balance sheet or amongst the headings of profit loss statement or cash flow statement. For example, let's see the balance sheets. So the current ratio would be a relationship between current asset and current liability. So I am having a relation between two headings of balance sheet. Similarly, the ratio could be relationships amongst each other, amongst the companies. So if I want to compare one company to another company, the best thing that I can use is ratio. So ratios acts as a binding tool, or it sets a relation amongst the headings of financial statements or amongst the various companies. So it makes our decision making in fundamental analysis and in equity research quite fast, basically, and it's very interesting. The purpose is to make of the ratios is to make faster decisions, right? So it is also used by all the investors basically. Now, guys, there are multiple types of ratios. It depends upon your usage. It depends upon what makes what makes your job easy, right? So it really depends. Different people use different ratios, but the thing is that there are multiple types of ratios. Let's just give you a glimpse. So when you open the screener, so in this peer comparison, these all are ratios, guys. You can see, right? We are going to discuss. So when you go to edit column over here, see, there's so many ratios over here. Quite a multiple amount of ratios you can find. See, about these are the ratios related to profit and loss statement. Means there will be a link amongst the headings of profit loss statement, quarterly profit and loss, balance sheet, cash flow statement. So these are related to cash flow statement. These are related to ratios, the which are ratios which are most oftenly used basically, right? So these are ratios related to price, means valuation of a company. So there are so many ratios. You can choose the way you like, the best you like, and which makes your job easy basically, right? Now let's come back to the topic. So let's give you a glimpse what types of ratios are there, right? Liquidity ratio, as the term itself suggests you. So let's read all the ratios first. Liquidity ratios, profitability ratios, efficiency ratios, solvency ratios, and market valuation ratios. Now, liquidity ratios, as the term itself suggests you, it is something related to liquidity. Means, for example, day-to-day task within a company, what is the working capital, free cash flow they are having, or, for example, electricity bill comes to your house, right? So how will you tackle that electricity bill? You will pay that electricity bill from your income, right? You will not sell your house for that electricity bill. So what I want to say, for this current liability, current assets should be used to finance these current liabilities. Means you should never liquidify your fixed assets for the current liability. So current should be financed by the current itself, not from the fixed assets. So these are day-to-day expenses, and if the company is having good free cash flow, they can easily handle these things. So current ratio and quick ratio are part of that. Means how quickly a company can overcome, a liability, a current liability or liability that just came across on the head. Means it just, hit the company on day-to-day basis. So company should have some liquid cash, right? So these are liquidity ratios to overcome, short-term obligations, right? So for example, the examples within this liquidity ratios are current ratio and quick ratio, right? So if I compare it with this company, so this is Sun Pharma. So when I open this Sun Pharma, guys, so these all are the ratios. So what I am doing over here, that one company, within the pharmaceutical sector, I am comparing it with the another pharmaceutical sector companies. Now, before I start further, I would like to give one disclaimer over here. That disclaimer is everything or whatever being taught in the class should be considered as educational advice. It is not an investment advice. All right. Now, few disclaimers I would like to give, and many people make this mistake, guys. Whenever I am discussing about ratios, so ratios are generally used within one sector. Means I can't compare apples with oranges. I can't compare TCS with Sun Pharma. TCS is a IT company. Sun Pharma is a pharmaceutical company. So ratios are used to compare the companies within one same sector. I can't compare two different sector ratios. I can't compare TCS with Sun Pharma using the ratios. You will make a lot of mistake in equity research if you do so, right? For example, if PE ratio of Sun Pharma is 37 and PE ratio of TCS could be around 30 or 32, but I can't compare it with TCS. So ratios should be used only for the comparison within same sector, not from different sector companies, right? So this peer comparison should be for same sector. So this is pharmaceutical. So we have to see which sector company I am dealing with. Sun Pharma, Cipla, Dr. Reddy, Mankind, these all companies are pharmaceutical companies. So I can relate them amongst themselves, but not with some another company who are different sector, right? This is first thing you should be knowing. Second thing that you should be aware of, multiple times we will be using these terms, current price or market value and book value. We will be using these terms multiple times, guys. So let's give you a glimpse what they are. So these will be very useful when we will be studying the ratios. When I start a company, right, and I issue equity, so I will issue equity. I will issue IPO shares on face value. Generally, the face value is considered as 10. So this is face value number one. We'll keep this aside. 10 was the face value. Eventually, when the company will start growing, right, I will start generating some profits. And that profits will keep accumulating into my reserves and surpluses, retained earning. I hope you remember that. So my reserves and surpluses will increase. And with those reserves and surpluses, I may give dividends, I may expand my company, or I may buy some assets, right? So those reserves and surpluses, along with face value, gives the book value. So what is book value of a share? So book value of a share is face value plus reserves and surpluses. So as my time will pass, so the face value that which used to be 10, right? Reserves and surpluses will keep accumulating and it will give a new face value, book value, right? Earlier, when my company started, book value and the face value was just similar to each other. That was 10. But as the time will pass, as I will earn more and more profit, the book value will keep increasing. And this is how the value of book is completely dependent upon the reserves and surpluses. With the time, it will keep increasing, right? So there is no sentiment involved here. There is no demand and supply concept, right? It is just reserves and surpluses. But guys, the market value on the current value of the company is dependent upon what sentiment people are having for that company. First of all, are the people liking that company or not? What is the demand for that company? So it is dependent upon the sentiment, dependent upon the demand and supply. So it is not related. Yes, reserves and surpluses and good performance always is a bonus, but generally, current price can be fluctuating dependent upon the demand and supply, market sentiment, all those things can change the current price. But the book value will stay constant only until the reserves and surpluses increases, only then it will increase. So why we are discussing it over here? If the difference between these two is very high, it means company is quite overvalued. So there we should find a company who is fundamentally strong. Firstly, means all the financial statements should be good. Secondly, there should not be much distance or much difference between these two, right? I hope this is clear to everybody. So this was example for Sun Pharma. So book value was 288 and current price was 17. So we are going to see these things again. Let's see for Adani. So Adani was in news for multiple reasons, guys. So over here, book value was 300 something, right? The current price now is 224. That is on, you can say, 13th of January. But few days back, few months back, it used to be around 3,000. Just see, 300, 3,000. The difference was quite high. Then along with that, we need to see what was the growth, means financial statements, how strong they were. And if the statements were not that strong, it means this was quite overvalued just because of the demand and supply. So the book value means the profits plus the face value means reserves and surpluses along with the face value. The current price or the market price is completely dependent upon the demand and supply or the sentiment of public against for that company. Along with that, I want you to always have an eye on this debt. Just have a glance on this. Nothing to be serious, but you should be seeing, what is the debt on the company. Sometimes infrastructure companies they have or capital intensive companies like manufacturing, automobile, real estate, they have quite high amount of debt. But if the companies, until and unless companies are making profits, it's fine. But if the company is not making profit and debt is also very, very high, then it's a risky company. And the company can or may collapse in future as well. So three things you have to keep in mind. You just, whenever you start your research, just see what is the current price, market value, what is the book value, right? Along with that, what is the debt on the company? Just keep an eye on this thing. It will really help you. And why we are studying current price and all this? Because we will be seeing this thing over here. What is the current ratio, PE price, the market price, and the earning. We will be seeing these things. Price to book value ratio, we will be seeing this over here. So we should know what is book value and what is market value. We should be aware of this thing, right? Now, we just touched current ratio. See, this is current ratio. So this is quick ratio. So this is how there are multiple types of ratios, guys. Next was profitability ratio. It will evaluate profit of a company, how much profit a company can generate. The best example is return on equity, net profit margins, gross margins. This is something we are going to discuss, right? Then comes the efficiency ratios. Very interesting ratios, guys. Inventory ratios, receivable turnover ratios. So the best example for this is see debtor days, inventory days, payable days, cash conversion cycle, working capital days. So we are going to see this thing as well along with this means how much time does it take for a company to sell the inventory or to get the cash back means whatever capital they had employed after how much time it is coming back to them to reuse. So that is efficiency. Faster the time, better the company will be. So it is much higher in real estate that we are going to see. Solvency ratio, as the name itself suggests you, measure for long run obligation. Liquidity was for short run and solvency is for long run, guys. The best example is debt to equity ratio and interest coverage ratio. I hope this is also clear to you. We are going to discuss all these ratios. And market valuation means whether the product or whether the share we are buying is it overvalued or undervalued. Best example for these ratios, these are very famous ratios: PE ratio, price to earning ratio, and price to book value ratio. So we are going to discuss these things as well. So let's begin from the first topic, liquidity ratio. The guys, what is the most liquid asset for a company? Absolutely. Cash is the most liquid asset for a company, right? So over here, current ratio is equal to current assets divided by the current liabilities. As I already told you, in balance sheet, we had discussed this thing that the current liabilities should be financed or should be overcome by the current assets only. There should never be a situation when for these current liabilities you have to liquidify the fixed assets. So current should be equated with current only. Current liability should be overcome or financed by the current assets only, right? Now, what should be the optimum value for this? The right optimum value for this could be from 1.5 to 2.5, right? And if it is less than 1.5, it means company is not having enough funds to overcome or to fulfill the current day-to-day, expenditures or day-to-day current liabilities that can arise. Or if it is much higher, it means company is having huge amount of money, but they are not, wisely planning where to invest the money. Means if you are having extra cash, why not to invest it? है ना? So this is something current ratio will tell us. So the optimum range should be from 1.5 to 2.5. So let's see the current ratio first, guys. Let's come over here itself. This is for pharmaceutical companies. So this is current ratio. So for this, it is 2.6, 3, 1.9. So as I told you, for the companies who are having 3, as current ratio means they're having extra cash. So Cipla is having some extra cash. They should utilize the cash in a better way. Mankind Pharma, they are having some extra cash in hand. They could have used this cash in some extra way. Now coming to Dr. Reddy, quite a good number, 1.9. Sun Pharma is okay, optimum. 2.5 should be good, 2.6 is also fine. So they are having good number as well. Apart from this, Zydus is having 2.2, fine. Lupin is having 1.8 and Aurobindo Pharma is having 1.8. So Dr. Reddy is 1.9. So I hope you got the point. Higher, very high number means extra cash, very low number, very risky. The company may not be able to meet day-to-day liabilities, current liabilities, right? Now, quick ratio, as the name itself says, which is the quickest asset, which is the fastest asset, most liquid asset a company can hold is the cash. So this is current assets minus inventory divided by the current liabilities. The formula is just the same. I'm just subtracting the inventory over here. Guys, quick ratio and cash ratio, they're quite similar. The numbers would also be quite similar to each other. You will see cash ratio also multiple times. It means how much cash, free cash company can have to overcome day-to-day current liabilities. Means how much current assets a company can have. So measure the ability to meet short-term obligations without inventory. Right? Now let's see. Quick ratio. So this is the quick ratio means how quick company can overcome the day-to-day expenditure. So this is the quick ratio, guys. So higher the number, it is around 2, it's good. Means if it is around 1.5 to 2, again it is good. 1.5 to 2.5. So it means, see, these numbers are quite similar to each other. There is no much difference, right? The thing is that, it should not be too high, it should not be too less. So if we see till now, Lupin is doing a good job. After this, Aurobindo is also doing good job. Cipla is having it, the number is very, very high for Cipla. Sun Pharma is having a good number as well. I hope this is clear, everyone. Current ratio and quick ratio, this is clear to everybody. Now, profitability ratio. Again, it tells about the profit of the company, how much profit a company can generate. Now, guys, it is return on equity. The formula is net income divided by shareholders' equity. So it measures return on shareholders' investments, right? Net profit margin, it is very simple, means how much profit margin a company can make on the net income revenue, right? Now, let's see over here, guys. So there are two terms over here, return on equity and return on capital employed. See, guys, whenever we talk about capital, right? So capital could be from equity, capital could be from debt. Equity is good, debt can be risky. So in return on equity, we are only including or taking only parameter as equity. Debt is not included over here. So what if the company had taken some debt? So that will not be evident in this ratio, right? In ROE. So ROCE is a better parameter than ROE. It will include both equity as well as it will include the debt part. So if ROE is 16%, it means they are including only the equity part. And if ROCE is 17%, so it means company used debt plus equity, and this was the return you can expect. So since we are talking about the profits over here, profitability ratio, so higher the number, as high as possible, better it could be. And definitely it should be higher than the inflation rate that we already has discussed. Means all the returns should be higher than 7% or 8%. So let's see over here. Sun Pharma ROE 16%, 16%, 21%, and ROCE, using of in capital when equity and the debt both are used. So these are the returns, average returns, right? So higher the number, better it is. So let's see which company is giving better returns. Sun Pharma is expecting, we can expect 17% in Sun Pharma, Cipla 22%, good. Dr. Reddy 26%, 24%. So this is how the numbers are. So this is CMP is the market price, guys. So this is the cost of the share in the market, right? So let's see. If I invest my money in Cipla, so I can get 22% return. And how much earning per share I can get in 12 months means what amount I can earn from one share over here. If I invest my money in Cipla, 55 rupees. This is in rupees, this is in percentage, guys. Dr. Reddy 64. So see the price of the share, guys. This is for 1400, this is for 1300. Which could be the better, which could give you the better return? 900 rupee, 42 rupee earnings. 2,000 rupee price. Now for this, we need to first understand PE ratio as well. We are coming to that as well. Now I hope you got the point. ROE and ROCE, they both are returns. ROCE is a better parameter than ROE. ROE will involve only the equity part. ROCE will involve equity plus debt. So it is a better parameter that will show you what were the returns when the company utilized both debt as well as the equity. I hope that is clear to everybody. Now, let's proceed to the further efficiency ratios. Next efficiency ratio over here is, the inventory turnovers. This is something we are going to see, you know, though the inventory turnover ratio should be as short as possible. For example, let's give you an example of a shop. There is a shop near to your house, right? And that person is having chocolates, but he's unable to sell those chocolates, and those chocolates keep on, piling up throughout 1 year, 2 years, and he's unable to sell the piles of chocolates. So those chocolates can get rotten in the shop. There's one more shop just near to your house. He's selling the same chocolates in just 5 or 6 days. So that second person is making more business because he's selling more chocolates. On the contrary, the first shopkeeper, he's unable to sell the chocolates, so inventory is getting piled up. So if the inventory is getting piled up, the chocolates will get rotten. Firstly, second, there will be misuse of the shop storage, or the, we can say, the space in the shop, right? Thirdly, the capital is also employed. He had invested money. Those chocolates are cash which he is holding, right? Which he is unable to sell. He can use that money to buy something else. It's an opportunity cost lying over there. So inventory turnover should be as less as possible. Means it should be very fast, and receivable turnover as well, it should be as fast as possible. This is not, this will be very difficult in infrastructure companies and in real estate companies. So in these companies, this ratio will be very, very high. So we are going to discuss that thing in a moment. Right now, solvency ratios, guys. Solvency ratios means what are the chances that company can get bankrupt, or company can, the company can collapse. Means, is there a parameter, or is there something that company has done wrong? So if some macroeconomic calamity comes, for example, like corona or something comes, what are the chances that company can collapse? So that is completely dependent on debt, guys. See over here as well, I told you, whenever you will be doing any research, start your research with just have an overview on the debt part. Just see what is the debt on the company. So this was for Sun Pharma. Just see for the Adani. So all the companies which are related to infrastructure or capital intensive companies, they have very high debts. For example, Adani was having 80 crore rupee debt, right? So the current value is also, the difference between current and the book value is also very, very high. So just keep this habit, just have a glance on the debt of the company. So if the debt of the company to equity ratio, if it is very high, guys, it's very risky. Let me give you an example. You are a salaried person, right? You take a home loan, for example, and you are just trying to overcome that home loan on day-to-day salaries. But guys, just imagine, Corona hits, you lose your job. How will you repay your EMI? So if it is for 1 or 2 months, again it's fine. But if the natural calamity, or some macro level economic event, or if you lose your job for 1, 2, 3 years, you will be in deep stress. You will be unable to pay the EMIs. Your loan will collapse. You can default the loan, and the entire system will collapse. Same happens with the company. Debts are good for the growth, but only until and unless when the companies are earning good incomes, revenues are good. If the revenues are if the revenue collapses, sales goes down, or something macro level event takes place, so the company will be unable to pay back the debt. And if it is for 1 or 2 months, fine. But if that thing sustains for 6 months or 1 year, like Corona, many company collapse during that time. So for solvency, it is very important. It will tell long run sustainability of the company. So we have to see debt to equity ratio. So what should be the optimum value for debt to equity ratio? Less is better. If it is zero, very good. If it is less, it's much better. If we are comparing the companies, right? Now, interest coverage ratio. See, guys, all the companies, they have taken some loan, right? And they have to give interest rates back. For example, I have taken loan from the bank. I am taking salary, I am receiving salary from my company, right? So every month I have to pay the interest. Now let's take the same example in the terms of company. Company is doing good, but it is having more loan. So they have to repay the loan, right? So they are making profits, but major chunk of the profit share is going to repay the interest of the loan. So being an investor, will you get good returns from these companies? Absolutely no. Why? Because the entire profit chunk is going to repay the loan only. So that is why debt is a very important parameter being a investment banking student. You should see what is the debt in the company. If debt is very high, so company has to repay that debt in future, right? So interest coverage ratio means it assesses ease of paying interest on the debt. That is why debt is very important because that is not something that is going to end. It is a sustainable thing. You have to pay the interest for a very, very long period of time. So absolutely, debt companies do take debt, but you have to see being investor, you will get your returns slow. I hope this is clear to everybody. Now, market valuation ratios. This is again a very important ratio and very famous ratio, that is PE ratio. See guys, let's give you an example. You want to purchase Nike shoes, right? The cost price of that Nike shoes could be around 3,000 or 4,000. Cost price, I'm saying. Generally, that Nike shoe is sold in the market in the range of 5,000 to 7,000. Sometime at 5,000, sometimes at 7,000, depending upon the demand. But during the sales time, it is sold at 5,000. So, being a customer, when will you buy the Nike shoe? When it is at the lowest, right? Let's give you one more example. iPhones. Generally, iPhone costs around 70 to 80,000, right? But once when they are launched, the same iPhone can cost you 1 lakh rupee. After a few months, or maybe during the Diwali sale or maybe New Year sale, you can get the same iPhone at 75,000 or 60,000. See the gap, guys. So being a consumer, when should you buy iPhone? When it was at 1 lakh rupee or when it was at 60 or 70,000? Obviously, when it is at the lowest, right? So the valuation ratio tells whether the price is overvalued or undervalued. And being a consumer, being an investor, I should be investing the money only when the PE ratio is least or PE ratio is less, or which company I should be investing my money in when the PE ratio is least, right? So the ratio means it is market price per share. Market price is what is the cost, means what is the value of the share in the market, right? This is PE ratio, guys. For example, let's see. So this is the market value divided by earning per share. So you will get PE ratio. So lower the PE ratio, it means you are getting the same share at lower price, right? Just like example of iPhone, just like the example of your Nike shoe. Now, for example, next is price to book value ratio. This is something we had already discussed, market price to the book value. So if there is a huge gap between these ratios, means if this ratio is very high, it means you are buying the stock at very high valuation. So both the values should be as low as possible. Let's give you an example. So whenever you will be applying these valuation ratios, first we will be seeing what is industry PE. Industry PE means it is for this you can say pharma company. Let's open for the Sun Pharma first, guys. So this is for Sun Pharma, right? Now, let's see what is PE ratio for pharmaceuticals. It is 31. Okay. So it means if the value of any company is less than 31, it is just like an iPhone, you are getting it at cheaper price. And if it is higher than 31, it means you're buying the same iPhone at higher price. So let's see over here. So Sun Pharma is having PE ratio 37. It means you're buying the iPhone at higher price or buying this company at higher price. Cipla is having 25. It means you're buying the same iPhone at lower price. It means Cipla is at optimum value right now. The price is less, right? Dr. Red is 20. Means it is more undervalued right now. You can buy it. Means that is why we say we need to buy the things at cheaper price. So this is a cheaper price you can get right now. Mankind Pharma, oh my God, 53 rupee. It means you are buying an iPhone at very high price. So you're buying this company at very high price. It should be just near to 31, this ratio. So first we have to see what is the industry PE, and then we have to compare all the numbers. We have to compare all the numbers of all the companies. That would be better, guys. So the least is for Aurobindo Pharma. It is 18. It means it is the least value right now. Means you're buying an iPhone at just 30, 40,000. Just like that. Now we have to see multiple parameters as such, but this P/E ratio will tell what is the real value of the company. What is the company right now costing you? Means it could be a good share, but you can buy a share at very high price. Again, it can give you losses. So this thing I had already told you in technical analysis. Even a good company can give you losses. Even a bad company can give you profits. It depends upon the entry and exits. If you enter in Reliance at very high valuation, you will make losses from Reliance itself. Your profits margin will become contract. Yeah, will shrink basically. If you buy a bad company at right entry point, even that company can give you profit. So we have to see what is the PE ratio of a company. I hope this is clear to everyone. Now this is market price to book value, right? So this is again lesser is better. So for this, for this it is less. Again, it will be completely evident, guys, over here. For this, it is again less. So it will be less definitely for the companies which are having less PE as well. So we have to see which is having less PE ratio. So if I tell you that, guys, if PE ratio is less and if you buy the company, chances are there you will get more profits. You're buying the company at discount. You're buying the iPhone at discount. You're buying the Nike shoe at discount. Better the discount, higher you can get the returns. Now, one more thing that you should be seeing over here, guys, whenever you are doing any kind of investment, you should see what is the low and high of that share. Let's see, for example, right now the share is at 1746, right? This is 13th January, right? 2025. Now, the highest this share have gone, that is 1900. And the lowest it has touched in last 52 weeks was 52 weeks means 1 year. In last 1 year or last 52 weeks, the lowest it touched was 1200 and highest was 1900. Now, what I have to do over here, guys, let's give you a scenario. What if the share price right now is 1800? Maximum was 1900. So what is the margin? I can maximum I can earn 100 rupee profit. Maximum I can earn, that is 100 rupee profit, because I am buying this share already at high. Similarly, if this share is around 1900 and the difference is 1960, so maximum profit I can make is 60 rupee, guys. See, my profits are getting shrink, though company is good. Now, if I buy the same share at 1100 or 1200 or 1300, let's take 1200. So the maximum was 1900, so I can wait for some time until and unless it hits the 1900 mark again. So I can easily make 700 profit. So the same company is giving me 700 profit. The same company is giving me the profit 60 rupee. Now, which one you will choose? It is the time when to buy the share and when to sell. So you will be seeing two things: whether the PE is high or low. Compare this PE with industry ratio, right? Industry PE. Now let's see the difference between the market value and the book value that you can see from here itself, the comparison between both, right? And then you will see what is the highest and the lowest. This is important, guys, for the valuation part. You will be seeing these things. And then you will have a better idea of should you wait to buy the company, keep it in the watch list. If you want to buy immediately, if the prices are low, buy it. So this is how we have to relate the valuation ratios, guys. I hope this is clear to everybody. Now let's do few examples now. Now, I hope this is clear to everybody. Now, the thing is that, let me repeat myself again. You will be using ratios only for the companies within the same sector. I can't compare two companies for two different sectors. That will be a complete wrong judgment. This is first thing that you have to see. Now, this is for Sun Pharma. Let's see for pharmaceutical companies. So this is the market value, means what is the present value of the companies, right? This is industry P. Industry P is 31. Okay. Now this is PE ratio, price to earning ratio. So as I told you, it should be as low as possible. Lower means you are getting the share at discount. So till now, this one is good, this one is good, Dr. Reddy is good, Zydos is good, right? 37, bit high, bit. Mankind Pharma is very highly priced. So I will be waiting. I will not invest in Mankind Pharma right now. I will wait. Anyhow, never mind. This part, Sun Pharma is also not that high. It is also good. Fine. Means it's just 6 point high. If it would have been 53, then it's a complete no. I will be waiting for that. Let's see the uh, market value and the book value ratios. So again, I have to compare it with this. Means if the ratio is very, very high, then see over here, Mankind Pharma is very high. So it means the value right now for this share is very high. It is just for an example, the iPhone is costing you right now at 1.5 lakhs. You can buy the same iPhone at 60, 70,000 during the sales. So you just have to wait for the right time. So this is telling you the right time, guys. Now, earning per share. How much you would have earned from one share in last 12 months? So for Sun Pharma 46, for Cipla 55, these are the numbers. These are in rupees. So if you would have invested 17,000, you would have made on an average this much amount of money. So we have to see as this thing as well. What are the maximum returns I can expect from here, right? Now, operating profit margins. This we had already covered in profit and loss statement. Generally, you can see the trend. Means all the companies in pharma sector can make at least profit margins of more than 20%. It's a good sign. And which company is making more profit margin can have better profits, means better revenues, right? So profit margin is just like that, guys. You are earning more and more profits. Now, quick ratio. Quick ratio should be between 1.5 to 2.5. Same goes for the current ratio as well, guys. So for Mankind Pharma, the numbers are high. So see over here, I'm not shortlisting just one company, but it is giving me an overview means which company could be better, which company could is not better. So Mankind Pharma, there are multiple red flags. So it's a good company fundamentally. But these ratios are telling me that I should wait for some time before investing so that my profits increases, right? Now, Aurobindo Pharma was having good numbers. Numbers are good as such. The ratios were also good. So till now, you can see this is also having a good number, right? The market value is also good. Dr. Reddy's are also doing good. But these ratios is also doing good. So by doing this comparison, guys, I can shortlist two or three good companies. Now, after listing two or three good companies, I can then move towards profit loss statement, balance sheet, and cash flow statement. So using this, I am rejecting one or two companies and I am selecting one or two companies. That rejection could be based on overvaluation or undervaluation, or maybe there are other parameters. Now, interest coverage ratios means these are the ratios depends upon how much money or how much money is going on the interest that we had already seen, right? So if the number is higher, it means they have to pay more money to overcome the debt. And debt to equity ratio, again, it should be as less as possible, guys. Because again, it is both the ratios are talking about debt. And as I told you, debt is very risky for a company. So if the numbers are less, it is good. So let's see over here, guys. You can also add a column of debt over here. Which company is having how much debt? You can edit the column. You can add that column over here. So till now, if you can see, Aurobindo Pharma is having bit high. But good thing is that, guys, all the companies are having very less debt. If you compare these numbers with the real estate or infrastructure, this would be very, very high, guys. So till now, all the companies are having very less debt. Still, if you compare these companies, uh, this is having again less debt, right? This company, Dr. Reddy, is also having less debt. So, guys, what I am doing over here, I am shortlisting few companies which can give you good returns in future, right? So, if I see the maximum return 64 rupee you can earn from Dr. Reddy, 1300 was the price. PE ratio was also low. This was also low. Earnings were also high. Operating profit margin was also high. Quick ratio is also in optimum number. This is also in optimum number. So till now, all the companies were good, but I can shortlist this company. At least this is better. I hope you're getting the point, guys. Means I am shortlisting better amongst all, or I am rejecting few companies. Right now, return on equity percentage is also good. So it seems like Dr. Reddy is doing good. It's not an investment advice. Just I'm saying it is fulfilling all the criteria. That was also low. The ratio was also low. This was also low. You can compare the things again, guys. Now, return on equity percentage was 21 and ROC is again 26. Good numbers. I hope this is clear to everybody. Okay. Now, let's compare for some another companies. So, let's go for this time Himadri. So, let's go for the chemical companies, guys. Just keep an eye on this. The book value of 69.70. Current price is this. Mm, Gap is high, but not that high, right? Debt 300 crores. Okay, we just have to glance it. We just have to take it. You don't have to take it seriously. Just put a habit of glancing it. Just have a glance. Now let's go to peers, guys. Now these are Pidilite, SRF, Gujarat, Godrej Industries, Deepak Nitrate, and Himadri Special, specialities. So these are the companies. So these are the market prices of the shares. So 2,000, 2,500, 6,000. So quite costly companies as well, right? Industry PE for this sector is 31 rupee. Everybody. So this is 31. 31 is the ratio. Now PE as compared to industry, let's compare this thing now, guys. Now we have to see which company is overvalued and undervalued till now. It is very, very evident seeing the number. Linde India is very overvalued, overpriced. Gujarat Fluorotech overvalued, completely rejected. Red flags, straight. So out of seven, completely two are rejected. Book value ratio would also be high for these, right? Now we have to shortlist few other good companies. Let's see all the ratios first. Earning per share, 12 month, was highest for Linde, okay, but the cost was 6,000 for this share, right? 62 for Deepak Nitrate. So till now, Deepak Nitrate is doing good as such. The PE ratio is also not that high, right? It is also in a good way as compared to others. Right now, let's proceed further. Operating profit margin is also good, 14%. For Pidilite, it's 22%. For Linde, it's 27%. So till now, it is optimum, right? Now, quick ratio is around 2.7, fine. Current ratio is very high, means they're having extra cash in their hands, guys. Now, coming to interest coverage, 56. Uh, Debt to equity ratio, 0.7. Okay. Return on equity and return on capital employed. Now, guys, let's compare other numbers as well over here, which is having least debt over here. The least debt is having in the Linde. Okay, we can open this thing as well. Apart from this, but the cost price, the market value of Linde is very, very high. At 6,000, just one share for 6,000. Over here in Himadri, it's 2,000 rupee. Deepak Nitrate is for 2,000 and Himadri is for 500. So just imagine, guys, see the difference as well. Means how much investments you have to make to buy just one share or just 10 shares, right? Now you have to see debt to equity ratio is least over here in Pidilite. Okay. Interest coverage is okay this much. SRF is 0.44 and highest is for Godrej. So you can see over here, guys, Godrej is having all the things which are not good for our investments. PE ratio is also very high, right? Returns were also very less, right? Operating profit margin is also very less, and the debt to equity ratio is also very high, and the returns are also very high. So if I'm saying this thing, that we are combining multiple parameters now, guys. We will be shortlisting few companies from here and we will be rejecting few companies from here. So Godrej is quite a reject from my side, right? Pidilite could be selected because debt to equity ratio is very, very less. P ratio is quite high, but still we can think of this. Operating profit margins were high and rest ratios were also good, right? Now, apart from this, this was also a reject. Gujarat Fluorotech was also a reject. Godrej Industries rejected. Deepak Nitrate was good, and Himadri Chemicals was uh, 10 10 rupee. It is also difficult to choose this company because the only parameter I can choose this company would be the market price. So if I choose two companies over here, that would be Deepak Nitrate and Pidilite. So it saved my time. Now I don't have to see, I have to go to financial statements of all these companies. Now few companies are rejected and few are selected. So I will be selecting Pidilite and Deepak Nitrate, and then I will be reading financial statements of these companies. So Ratio analysis is shortlisting few good companies amongst all the competitors. So this is the main role of, you can say, the ratio analysis. I hope this is clear to everybody. Now, I would like to tell you one more thing over here, that guys, that is, for example, DLF. So it's a real estate company. So let's see over here, guys. The thing is that these ratios, these are the debtor days, inventory days, days payable, right? These are important terms. It means what is the cash conversion cycle? Means if today I start a business, I manufacture, and I have some inventory, how much time that inventory takes to get sold off, that is first parameter. If it is taking too much time, again my money, my capital is stuck, I have to use a store, uh, my storage would be full. Second, there is a chance of getting the entire inventory can get rotten, right? So there are multiple things. So inventory days are how many days it takes to sell a product. Okay. Debtor days, after how many days the customers are giving my money. For example, I buy a house today. If I am a seller of something, for example, I am selling chocolate. So you are giving me the money for this to buy this chocolate at the same day, or you are taking it on credit. You are giving me the credit after some days. So over here, it's around 70 days. See, guys, or maybe sometimes 126 days. Means it is generally 2 months, right? Days payable means after how many days I am giving the money to my, suppliers. So it is company payment cycle towards the suppliers, debtors toward the consumers or customers, inventory, how many days the inventory keep piled up, right? The cash conversion cycle, it means today I started manufacturing, and after how many days my inventory got sold and the money came to me. This is the complete cycle, right? So this is called as cash conversion cycle. So number of days, all these days should be as less as possible, right? Now working capital days means once I started from equity or loan, I took loan, I started construction of the house, then I made the houses, then I sold the houses. After how many days the money came back to me? So in real estate, guys, generally it is very high. See, 600 days. It is 2 years, guys. Sometimes 1000 days as well. 3 years. Longer is the time, right? It will become difficult for the company to overcome its own investments. And you are investing in real estate, so that is why what happens. In generally, we say real estate cycle is 7 years. So if you are investing in company like DLF, so DLF itself is making profits after 3 years, 2 years. So being investor, you will get your returns after a very long time. So what I want you to say over here, whenever you are investing your money in either in capital intensive businesses or in real estate, your money will take a lot of time to get recovered because they get their money. The cycle is very long for the number of days. So these are debtor days, inventory days, right? Working capital days means whatever capital they had from the start, from the bank, whenever they started their business by taking loan from the bank or equity, and how they, started their construction, how they sold from that time. These are the number of days they took. So it's quite long. For example, Godrej Properties. So again, it's a real estate company. So in real estate company, see guys, working capital days is quite long. Cash conversion cycle is also long. So being a buyer or being a investor in these companies, you have to keep in mind if I am a manufacturing company, how much inventory is there, firstly, how much time does it takes to sell that inventory, and after how much time my money is coming back to me. So the number of days also play a very important role. So if these days are as less as possible, it is better. TCS, for example. So in TCS, the number of days are quite less, 1 month or 2 months. It's fine. Lesser the number of days, better it would be for the company. So what I wanted to say, let me repeat myself again. You don't have to take it too seriously, but I want you to just have a glance on this as well. Whenever you are doing something, whenever you are doing a research, just have a glance on this. Means what after how many days my money I will get my money back. So this is how you will have an idea. Means after how many days, if I invest in a company, after how many days my money will get back to me. Means after how many days I will get my profits. Means if the company itself is making profit after 2 or 3 years, so similarly you will also get profits quite late. I hope this is clear to everybody. Now, ratio analysis provide snapshot of the financial health, right? It helps to let us know what is the benchmark performance, right? And it aids in the decision making in the company. I hope this is clear to everybody. The only limitation is that it's not something black and white. It's not something that you will straight away get to choose one company straight away. No. Out of these 7 companies, it will help you to shortlist 2 or 3 companies. Means it saved your time, to analyze all these 7. Instead of analyzing all these 7 companies, it saved your time. And now you have top 2 or 3 companies. It will shortlist top 2 or 3 companies. This is a main important thing. Second, you can compare companies within the same sector, right? You can't compare TCS with Sun Pharma. So this is again a second parameter that you have to keep in mind, right? Now we completed the practicals as well. So today, if I summarize whatever we discussed today, whenever you start your research, just see the current value and the book value. If the current value is very high, market value is very high, and the book value is quite low, if the difference is very high, straight away you should keep in your mind, okay, it is overvalued right now. You should wait this price to come down. Secondly, you should see this thing as well. You should see whether the company is close to the lowest value or the highest value. If the market value is close to highest value, it means your profits would be less. If this value is lowest or nearest to this lowest value, it means there are good chances of you to making good earnings. And then keep an eye on debt as well. Over here, one disclaimer: all the capital intensive companies into real estate, infrastructure, or automobile, they will be having higher debts as compared to other companies. Then coming to peers, there are so many ratios you can use, as many ratios as you want. Now these ratios will help you to compare within the same sector. Firstly, secondly, it will help you to shortlist 2 or 3 companies. It won't give you just one top perfect company. It will help you to shortlist 2 or 3 companies at least. And then in those 2 or 3 shortlisted companies, you can apply the further fundamental analysis, that is profit and loss statement, balance sheet analysis, and cash flow statements. Then come the number of days. You should have keep an eye on this thing as well. After how many days the money is getting coming back to the company. As if the number of days are as less as possible, it's better. But if the number of days are very high, very long duration it is taking, you have to keep in mind that if you're investing in such company, you will get the returns later on. You will get your returns would also be getting they will also get slowed down, or the duration for your returns would also increase.